Portfolio Builder Update, December 27th. If you're seeing this video late, subscribe and click the bell to get instant notifications. Today everybody's wondering, did pension funds buy all the stocks they needed in just one day? Yesterday, the Dow jumped 1,000 points, record-breaking jump. Today, the market pulled back and has been trading sideways. Since releasing the Portfolio Builder Income platform on December 10th, right here, the market went on to puke an 8% loss. But because our strategy sells covered calls against our underlying basket of stocks, which are globally diversified, we are only showing a 1% loss. And you can see all the profits we made from selling covered calls during this period right here. Primarily on the SPY and the TLT, which represents the bulk of our portfolio, but also a lot of premium collected against our other ETFs covering China, Japan, Germany, UK, Brazil, and India. Now, just a few weeks ago, we had a 40% bond position and a 40% equity position, hedged with a 10% gold position and a 10% cash / digital money portfolio. But when we saw the VIX spike and the stock market crash, you can see on that December 20th, we alerted to switch to a new setting. And that's because the extreme fear marker got to 8. It actually went down all the way to 3. And we switched to a 70% equities position and a 30% cash position. And that cash was on the sidelines to increase our equities position if there was further drawdown. And so the 20th wasn't the absolute bottom. We did show some drawdown for the 21st on Christmas Eve on the 24th. But then the market jumped up yesterday, erasing most of our losses, and I suspect that in the next few weeks the market will rebound, most likely back into this trading range that it was bouncing in. And so right now our intentions are to run the 70-30 equity cash position, selling out of the money covered calls, expecting the market to go up, but to be cautious once it rebounds back to that levels, because this is the big event that begins in January. And that's that the ECB will be discontinuing the rollover of its bond purchasing, which is going to suck a lot of money out of the equities market to be forced into the government bond markets. And this could potentially make the TLT, which is what we use for our bond portfolio, go down in value, as well as create a downward effect on equities. So if that is the case, the next question is, how much downward pressure will we actually see? And so with a mindset that the market may either go flat or slightly down, we can sell covered calls against our core equity positions that are in the money and actually generate profits if the market goes down less than the strike price we choose to sell the covered call at. And if the market goes up, we may lose a small percentage of our equity risk doing this strategy, but we're able to protect against a much larger downside risk. And so our largest position in a defensive posture is the TLT, representing 40% of our portfolio. And we can see that leading up to the 2008 crisis, there was a rush into bonds for safety. And the volatility, even though it did have a sharp pullback, was still a lot less than the equities market. So we think we're coming into a time of volatility, and we still want to generate income with our portfolio for retirement. The TLT can provide that with a lot less volatility. But the only problem is that with America having a $1 trillion budget going into 2019, the supply is increasing while the buyers are quickly fading. So we may see a lot of pressure put on the bond market and the equities market going into 2019. Now, here's an interesting Twitter post I found just showing the day before, the day after, and the return 3 days later. Big drops are followed by big gains. The market has this way of going too heavy and then too light, then too heavy, then too light, until it finds its equilibrium over time. But it never really seems to stay still. Here's another good technical overbought sold composite graph where we can see how oversold the market was just a few days ago, which is why I began to jump into the heavy equities posture, even though I'm worried about the long-term picture. I knew that this would definitely have to go back to a normal and even swing to the other direction. Otherwise, we'd have a massive crisis on our hands. And if we also look at this chart, the S&P 500 versus the 200-week moving average, this has been a very strong magnet for the stock market over the last 70 years, very infrequently going too far above or below it for very long periods of time. So the market may be very fairly priced at current levels right now. Here's a chart that's looking at some potential retracement levels of where the SPY may potentially bounce back to. And the level I'm looking at before jumping back into a defensive posture is around the 26-25 line. Here's a chart that's very interesting where it has the Fed target rate versus the Dow. And if you actually extend this another 70 years back, we can see clearly during periods of interest rates being lowered, the stock market goes up. In periods of interest rate being continually increased, we have long multi-decade downward movement in the Dow. And so really over the past 4 decades, we've had a overwhelmingly loose monetary policy that continues to lower rates and lower rates while deficits get larger and larger for corporations and for governments. And if you look at the 1995 levels of interest rates, you can see it looks very similar to the current shape we are, just with lower rates. And from 1995 to 2000, we created the tech bubble. And that's with interest rates sitting at the Fed target rate just above 5% for a flat 5 years with just modest drops in the rate. And so even though in the short term the central banks do tend to try to raise interest rates and reduce their balance sheets, you have to wonder how long they can do that, and at what point will they lower rates again and start QE4. So trying to play the downside of the market is quite potentially a fool's game, but rather if you can just survive the bear markets and be positioned well to catch when the central banks start levitating asset prices again is really the name of the game. Here is the projected outline of Fed redemptions going into 2019. And so we can see their selling is just getting started in 2018 and will continue steadily into 2019. So is this already priced into the market at these levels, or is this going to continue to be very suppressive of equity prices? A few other good articles I saw today: why stocks are soaring, a massive $64 billion buy order. That was actually yesterday's headline. And so quite likely we had a lot of people happy to take a loss in the last few days to offset any gains they had this year. And then meanwhile, we had the bonds outperform equities, causing pension funds to do a massive rebalancing. And of course, Zero Hedge was joking, did they do it all in a single day? Where's the follow through on this reversal from yesterday? In this article, something is wrong. Deutsche Bank spots an odd market divergence. And by the way, a lot of people are worried that Deutsche Bank could single-handedly create the next financial crisis. And what they're noticing is that bonds and stocks are supposed to trade the opposite of one another. And over this last crash, they have both gone down in value. And so the big worry is that there's a lot of leverage and strategies that count on these two instruments having an inverse relationship. If that relationship breaks down for too long, it could create a massive amount of selling. And so we've been talking a little bit about some of the fundamentals of why this might happen in 2019. Next, a new piece out from Douglas Cass. He likes to make a lot of crazy predictions, and in the last 2 years he's actually had some pretty dead-on hits. He called the crypto crash. He called this recent stock crash. He did call for a rally that we got yesterday, and in this article he has a few good quotes to read to you. The list is the outgrowth of 5 core lessons I have learned over the course of my investing career. 1, how wrong conventional wisdom can consistently be. 2, that uncertainty will persist. 3, to expect the unexpected. 4, that the occurrence of black swan events are growing in frequency. And 5, with rapidly changing conditions, investors can't change the direction of the wind, but we can adjust our sails and our portfolios in an attempt to reach our destination of good investment returns. And so here's his top 10 possible events that could cause stocks to rise by at least 5% in one trading session. And these are all surprises I'm carefully on the lookout for to change our covered call strategy and essentially move the strike price above the trading price of the equity if we get bullish, and push it down below if we get bearish. So the number one surprise for the upside would be the Federal Reserve transitioning from the rigid language of gradual increases to a more flexible posture that would essentially cease raising interest rates and lower how fast it's pulling money out of the bond market. 2, Europe extends QE. Right now everyone's pricing in that the ECB will stop its rolling of its purchases of bonds. 3, China introduces a major easing policy that has substance, clout, and power, which they've already started to tease that they might do something like that. 4, Treasury Secretary Mnuchin resigns and is replaced by Hank Paulson. The U.S.-China trade war ends with a full resolution. Then he has always had various predictions of how Trump gets pushed out of the presidency. And then the last surprise would be amazing returns, better than expected results from Amazon and Google. So we shall see. Without some more big moves like yesterday, this market's lost its momentum and could potentially get nasty very quickly, as the VIX is currently about halfway as high as it reached in the 2008 crash. Meanwhile, over from Seeking Alpha, some headlines I'd like to read. U.S.-China trade meeting set for early January. Here's a look at the Chinese stock market with the ETF we use, the MCHI. It's a very volatile market. It's crashed for a year, but it could surely go lower if trade talks deteriorate. Now the question is, does China want to put more pressure on America and let this war escalate, potentially crashing their market back down to this 40 level? Or do they want to stop the bleeding as well? And so the bullet points read, a U.S. trade team will travel to Beijing the week of January 7th to hold talks with Chinese officials, according to Bloomberg. Since President Trump and Xi Jinping came to a temporary truce almost a month ago, Beijing has slashed import tariffs and drafted a law to prevent forced technology transfers. China won't resort to massive stimulus in 2019. afraid that the funds will flow into the property sector, which is already extremely overdone. China to lower tariffs on more products, cooling trade tensions starting January 1st. China plans to remove import and export duties on a range of goods, including zero tariffs on ingredients for livestock feeds. Significant cuts to taxes and fees will be enacted in 2019. And while monetary policy will remain prudent, officials will strike an appropriate balance between tightening and loosening, according to a statement published after the Economic Work Conference. Meanwhile, the Bank of England keeps interest rates unchanged. Over in cryptocurrency land, the rally fizzled out. It hit 4,100, came back to 3,800. While I want to continue to have exposure to cryptocurrencies after depreciating so much in 2018, I fear their next catalyst could be delayed until QE4, which would mean there may need to be a stock crash and then a stock rally to catch the next big ride of free money flowing into risky assets. Now, of course, there are other catalysts that could occur before that, such as a Bitcoin ETF. What's important for the time being is it's maintaining its high level of trading volume and maintaining this new price range between 3,000 and 4,500. And here's a final piece to wrap up today's video from Ray Dalio. And he says he's putting recent market moves in perspective. The short version is that he doesn't only think we're at the end of the current cycle, just looking at the 2008 crash and the 2000 crash. He thinks we're also at the end of the long-term debt cycle. So if you added every debt cycle over the past 40 to 50 years and turned it into just one giant debt cycle, he's saying we're approaching the top of that and that we have a very ugly multi-decade path ahead. And so he calls the short-term debt cycle a 5 to 10 year and then we have the long-term debt cycle, which is about 50 to 75 years. And he says towards the end of each cycle, you have a push towards populism and nationalism as the rich get very rich and the poor get into a worse and worse situation, and that it's happened over and over in history. And he notes that people always seem confused over and over again that while unemployment's at low and the economy looks strong as ever, that we're approaching a bear market, and that when unemployment's high, growth is low, stock markets crash, that's the time you should be purchasing. And he says that the long-term debt cycle comes around approximately once every 50 to 75 years and happens because several short-term cycles add up to steadily higher debt and debt service burdens, which the central banks try to neutralize by lowering interest rates. And when they can't do that anymore, they try to do so by printing money and buying debt, because most everyone wants to get markets and economies to go up, and because the best way to do that is to lower interest rates and make credit readily available, there is a bias among policymakers to do what is stimulative until they can't do that anymore. When the risk-free interest rate that they control hits 0% in a big debt crisis, central banks lowering interest rates doesn't work. That drives them to print money and buy financial assets. That happened in 1929 through 1933 and 2008 through 2009. That causes financial asset prices and economic activity to pick up as they did in 33 through 37 and 2009 through now. In both the 30s case and our most recent case, that led to a short-term debt cycle rebound, which eventually led to a tightening in 1937 and over the last couple of years. And for the reasons I previously described in explaining the short-term debt cycle, this time around, the tightening is coming via both interest rate increases and the Federal Reserve reducing its holdings of the debt it had acquired. For all of the previously described reasons, that period we are now in looks a lot like 1937. So that's it for today's update. If you haven't signed up to our newsletter yet, click in the left-hand corner of this video and sign up for your free 30-day trial. Thanks again, and look for a video tomorrow.